What's going on, guys? Good morning, good evening, wherever you are. Welcome back to another pre-market live stream here. Hope you guys had a great weekend. This week is going to be a pretty eventful week. We have FOMC on Tuesday and Wednesday. Let's get ready to rumble here. There's not a lot to cover on the macro stance. Let me just kind of tidy up and kind of connect some of the loose ends from last week. Seeing it's Friday, we didn't have a live stream because I had some stuff to do in real life, and so I had to attend to it. But thank you for coming back on Monday and attending the stream. Appreciate you taking your time out to be here. Once again, these streams, they are definitely going to be a consistent thing as much as I can, but sometimes life comes in the way and you just have to attend to certain things. So unfortunately, I had to be out on Friday. This week we have FOMC, and on top of that, last week we had the banking turmoil that caused a little bit of the sell-off on the SPX, or rather the entire market wide. We had over the weekend UBS buying out Credit Suisse, which honestly was a great deal for them. I think that the distressed assets that the bank is going to take on is going to be a good way for them to expand their balance sheet in terms of what they're hoping to achieve for their own sector of the market. Not forgetting that they pretty much bought their competitor. But then again, Credit Suisse has had this coming for a while now. So I think a lot of people that are not recognizing or don't know anything about Credit Suisse is that they've been underwater for a while. This kind of absorption by UBS is not really a big deal. In all things considered, UBS is a pretty big bank and a pretty big boy, so it can take on and absorb all of the assets of Credit Suisse and all of its bad debt, and kind of push forward, in that sector and region of the world. Okay, so all in all, I think it was a good acquisition. Now, not to forget that this week, FDIC will be putting up the sale of SIVB and Signature Bank. By Wednesday, I believe, is the deadline for people to put in their bids. And there has been a lot of chatter of the Oracle of Omaha, aka Warren Buffett, coming to the picture. Now, we don't know what is the actual, thing that's going to happen. But, if SIVB gets acquired by Warren Buffett, or the likes of anyone maybe close to Warren Buffett, or maybe Buffett is just part of the deal, then this bank is going to see significant inflows once again. It has been pretty much halted and taken off the trading list, but it could be injected back with fresh liquidity if somebody with the muscle takes over the bank. Now remember that this was Silicon Valley's pride and gem in terms of funding VC investments and things like that, as well as smaller businesses. So it wouldn't make sense for a smaller bank to take them over. Obviously, they would have to have somebody with bigger muscle to come in. And honestly, Buffett is not really the worst choice here, mainly because he already does have experience with some banks. But the only thing about that is it's not characteristic of Berkshire to do a purchase like this, mainly because they are a sort of investor that comes in when a system is already in play and it's working, not a system where it's broken and they have to come in and re-augment management. Berkshire doesn't specialize in that kind of a move, but I'm pretty sure that if Buffett wanted to put his money behind it, this is the kind of distressed asset that he would be looking for to deploy some of his elephant cash pile that he has. So do I think that Buffett will be a person that purchases part of this deal? There is a 50-50 chance. That's what I would say. It's a 50-50 chance. But in my opinion, it's not a Berkshire-style deal. That's what I'm going to say. As I said, he would rather wait for somebody to come in, re-augment this business and make it a profitable business and then put his money into it, rather than buying this business which is currently drowning underwater. So with SIVB and Signature Bank, we'll know more by Wednesday. And then continuing on with that same analysis slash exception for this week, we have FOMC that is going to take place Tuesday, Wednesday. I think the minutes on Wednesday, Tuesday, FOMC. And then get prepared for the questions and the press conference. So make sure that you don't make any abrupt moves until after the press conference. That's when the real move will happen. Okay. What is the plan for this week? I've just sent the newsletter out maybe about less than an hour ago, so maybe about 30-40 minutes ago. And this is a very simple plan for this week. Bulls need to recap. So let me go through the bullish scenario first. Bulls need to capture 39.40 and stay above it in order to recapture 40.60. Okay. We need to hold above 39.75. This is the key pivot for bulls to secure 40.60 this week. And that will set us up for that upside move if we do get it. Okay, if we stay below 39.75 and we stay below 40.60 and we stay below 39.40, this opens up the bears to pressure down the market back to 38.80 and then back to 38.25, I believe. 38.35, 38.25, let's just say somewhere around there. Basically where this demand zone is, right? And that demand zone kind of ends at around 38.15, but honestly give it like a 10 point, excuse me, a 10 to 20 point grace period above it, or a 10 to 20 point handle grace above it for that upside downside pivot. And if we do indeed slam beneath this 38.80 and start plummeting downwards, then the main level to break for bears and hold control is to hold below 38.80 and then break below 37.80. And obviously this range that I'm giving you guys is for at least another 1 to 2 weeks. Okay. Now, what do I feel is the better risk to reward ratio move? Obviously the upside move, right? And so do I want to trade the downside move? Absolutely not. Where we are right now is what is called no man's land, and this upside and downside risk to reward ratio is absolutely the same. Therefore, I take no interest in trading this chop, which might happen sideways. Now, things that can happen is we can come down and grab liquidity at 39.80 and then come down and grab liquidity at 38.15 or 38.25 and then push to the upside. That could be one of the scenarios that play out this week. Okay. The other scenario is if we come up to 4,000 or up to 39.75 again for a double top, and then slam down ahead of the FOMC meetings on Wednesday. Okay, so there's two bullish bearish scenarios. You need to be prepared, and obviously hopefully you've done your homework over the weekend and you're prepared with what you want to trade for the week. There are a lot of opportunities in this market right now in all sectors. Okay, just to give you guys a little bit of a insight on where the sectors are standing, here you go. This was mainly what we saw last week. Technology, NASDAQ, utilities seeing a little bit of inflows, communication services as well. Worst performing asset class was obviously financials, followed by energy, with both of which we have been talking about on this live stream extensively for weeks and weeks and weeks, where I called out financials being bearish for like 9 consecutive weeks because of the prime book data that we saw. And then last 4 weeks I told you guys about energy going bearish, and I was waiting for that play, and we took that play last week with XOP. We played the short position right when it retested 126 here, and boom, it came all the way down into this 115 level. That was a beautiful play, almost paid out close to 60%. Last week on the trading journal, I closed out close to about 30 some $1,000. So you can see all the plays here. These are all the plays that we took. XOP itself paid out close to, I want to say, granted that I had a very small position, but it paid out close to $2,500 on that trade. But yeah, last week was a very good week for me personally. I mean, I think, you know, one red trade the entire whole week, and, you know, a lot of these plays were driven by breakout or bounce levels. One of it was a rejection level, one was momentum, the other two was macro, which was XOP, and then there was a gap fill play with NVDA that we played. One of it went wrong, one of it went right. There was an intraday squeeze by SPX multiple times that has scalped, and then breakouts on key levels. This paid very handsomely, almost $10,000 right there. On Thursday and Friday, I didn't really trade, so there's no trades on Friday. And so, you know, this is the reason why we keep a very tedious journal here, and obviously all of this is posted on the Discord All the trades that we take are posted on Discord, especially all the profits and losses for every single trade that we take during the live trading sessions are all posted here for all the members to see in terms of transparency, so that there is no, no way for anyone to say that, oh no, this is not the trade that we took, because everything is called out live, everything is followed up live, all the trades are managed live, and that way, everybody can see what's going on. So if you're interested in joining the Discord, remember, link is in the description. 14 days free trial is still available. You can join us. Make sure you hit that like button, by the way. Yearly profit and loss currently sitting at around 215,000. I have made some allocations to some equity in the past couple of weeks. Some of the long-term plays that I have bought are, for example, Goldman Sachs and JP Morgan, which were trading at distressed levels. I took the opportunity to add those, and Domino's Pizza, which I just added last week. So yes, I have been adding some equity as this market comes down, and just kind of chugging along with where the market is. So yeah, let's see how this plays out this week. Now, if you have any chart requests for me, go ahead, put it in the chat or the comments right now so that I can take care of it. But let's go on with the technical analysis. Now, not a surprise that I have been mentioning NASDAQ has been the stronger sector. And I told you guys that when the market rebounds from this, NASDAQ is going to be the first one to rally. I mentioned this almost, I think, for 2 consecutive weeks on this live stream. I hope that some of you have been paying attention and kind of playing along with that. You need to understand what is moving, where it's moving, how it's moving in order to take advantage of it. And obviously, last week we took advantage of this with plays in Microsoft, plays in NVDA, all the main tech companies. We've been playing into those as well as SPX on rebounds. So even JP Morgan on Thursday for a rebound play. That was a really good one as well. So we're really looking for NASDAQ to break out of this 12,700, 800 key pivot for bulls. That would be a nice move to the upside. Give us maybe a retest of that 13,700. Obviously, long way to go, but still, if tech continues to be strong, that's what we will be expecting. But obviously we need some pullback. So let's have a look at Magma. Amazon up first, and we kind of rejected off that $99 level last week. We'll be looking for a reclaim of this level. If bulls are not able to secure it, then it's going to continue being suppressed and probably go down to retest that $95 level up, like around here, which has been a key level for bulls and bears to fight it out at. Similar structure came up with Google, came up to the 102 level, and then got rejected the close on Friday, and we'll see as the gaps down this morning. If we can come down to 97.60, 97.70 here for a retest and a bounce, that might cause a nice little bounce to the upside here. Obviously, this are all in contingent with the fact that the Fed is going to make the right decision this week. So, what will the Fed do? That's the golden question of this week, and I have some obvious examples of what are the likely scenarios for this week. Now, bond market here is pricing in the likelihood of a 25 basis point rate hike, okay, for this week. The federal funds rate is pricing in a 25 basis point rate hike, which is honestly, all things considered, not a bad decision. Now, you have to realize the Fed is almost met with the impossible situation here. Either they don't rate hike, and then they run the risk of inflation being higher, and that makes them a bad actor as well. And if they do rate hike and they do it too aggressively, then that creates more cracks in the economy, or maybe other banks that might collapse. But then if banks have good risk management, it's likely not to happen. Make sure you read the newsletter that I just sent out, because I have made the case for both sides of this argument in the newsletter. More importantly, I've also answered a very important question, which a lot of people have been getting wrong over Twitter and the financial community in general. The money that has been lent by the Fed is not QE. And you guys need to understand this. It's not quantitative easing that has come into the system. Quantitative easing is the printing of new money, and everybody is like, oh yeah, so basically it's quantitative easing. No, it isn't. And anybody who says that is dumb as, I don't know what to say, right? I don't want to say the F word, but seriously, if you think that what the Fed has done this past week was QE, and you think that, oh yeah, the Fed just printed $300 billion and put it back into the economy, that's not what happened. They lent the money out. The lending has a due date. It has an expiry date. It's like an options contract, almost. And that money that has been lent has a purpose for it. It's not just, oh yeah, we're gonna put it in the economy and see where it goes. So whenever you hear things like that, and there's a lot of people that like to just slam, and they think that they're like hardcore financial analysts or something, and they don't know anything about the economy, but they just like to talk shit about things. Ignore the noise, please. Ignore the noise and actually study something about the Fed before making those kinds of remarks, because honestly, it doesn't come off as making you look brighter. It actually comes off as making somebody look like as though they completely don't know anything about the economy, which is really weird, because I think that there's a lot of those kinds of people on Twitter that is really quite surprising. I sometimes find it very surprising that they say such things. So what has happened is money has been lent. It will have a due date. The money will be put back into the Fed's lending line of credit. And remember that something is not QE until the Fed puts it on its balance sheet. And the Fed has not taken any of the distressed assets and said, oh yeah, you know what, we're going to just buy these assets and put it on our balance sheet. That did not happen. That is what QE is. When the Fed steps in and buys exposure or bad debt, okay, that is what we call quantitative easing, because they actually inject money into the system and that money is printed. But now, it's not the case. With this financial system that we see, the cracks in the financial system that we see, these are many bad actors that had bad risk management. They have to alleviate those pressures by going to market to borrow money. And the bank takes on that risk. In fact, if you realize in this past week, you would say, oh, JP Morgan and a bunch of other banks stepped in and lent First Republic Bank a line of credit for up to $30 billion, right? So, oh, wow, that was also money given by the Fed? No, it wasn't. The Fed banks, the approved banking, or the approved banks by the Fed are lending each other money. This is as good as using the federal funds rate, right? So for many of you that don't know what that system is, I really hope that, you read up more about it, because, you need to understand how that system works. It's not as easy or as simple as people think that system is. So either way, this week we're likely to see the Fed raise about 25 basis points in the rate hike decision. And I think a 25 basis point rate hike decision is pretty modest, and I think it's a good decision because it will still keep inflation tracking downward. And honestly, if more banks blow up and the system collapses, I honestly see that as a positive. It's a net positive thing to society, because we need a reset in terms of these inflation, like these prices in terms of assets. So if you think that things are too expensive now, let the prices crash. Then everything is going to become cheaper. So as an investor, I'm always looking for the opportunity to buy assets or distressed assets. And to be honest, I think that if that does happen, then it just shows that the economy has been overheating in terms of those price levels, and that people need to actually tune in and listen to the Fed, right? So don't fight the Fed. Obviously, that's one thing that we've always heard. But another asset class that has been rising here is gold. Now, gold is obviously one of the choices of asset classes where a lot of investors flock to when the economy is uncertain. So, and I'm going to be really blunt with you guys. I don't enjoy trading gold that much. And not only that, I'm not very well versed with this part of the economy, because gold is a very speculative investment. Not only that, it pretty much is a non-productive asset, which means apart from the cash flows that it produces through speculation, where prices can go up and down, which produces capital gains, it isn't a asset that produces cash flows, right? So I stay away from assets like this until and unless there's a clear way for me to exploit arbitrage in terms of emotions where greed is too high or fear is too high. I personally wouldn't want to be trading this. But for all of you gold traders out there, Godspeed to you. I hope that you've made some money on this run. But I don't have really much updates to give you guys, apart from the fact that it's rallying, and obviously it's rallying on the back of people being uncertain about the economy. Now, other things that you need to be aware of as we head into this week for the FOMC meeting that's about to take place is the bond market and where it is, the state of the bond market. What is the bond market signaling here? And one thing that you need to be aware of is the yield curve, which has pretty much gone inverted again. And obviously it has been inverted for a while, but there was a brief moment in time where the mid of this bond market was starting to come down a little bit, and we were starting to see the inversion kind of get undone. But then as of last week and the whole debacle with the shorter time frame bonds, we're seeing the inversion steepen again. And so this obviously, what does this mean? It means that the market is pricing in the likelihood of a recession once again within the next 12 months. That's kind of what it means, okay? In like long story cut short, roundabout manner, TLDR way, without me going into too much detail. Which, by the way, if you haven't signed up for the webinar that's about to happen in 6 days from now, I highly recommend you to do that, because we're going to go through the bond market extensively when doing that webinar. And I'm going to break it all down for you in a more simpler manner so you can understand it, right? So the bond market's pricing in the possibility of a recession heading our way in the next 12 months, with short-term bonds, having higher yields than longer-term bonds. You can see, a lot of these, especially the U.S. 3-year bond has a 4.5%. And a U.S. 6-year bond has about, a U.S. 3-month and a U.S. 6-month bond is commanding about 4.55, 4.7%. And if you remember, just I think maybe 2 weeks back or 1 week, no, maybe before the financial debacle thingy, we had a majority of the middle of this bond market commanding about 5%. And we saw that the bond market has changed very rapidly here, pricing in the likelihood of a rate cut rather than a rate hike. So with the bond market commanding higher rates in the short end, again, this sets up boomerang where the market's going to be pricing in the likelihood of a recession, and then that creates more pressure for short-term bonds to be bought, which sets up the likelihood of the S&P 500 being in a drawdown situation for a longer period of time to be more complex. Okay. Now, do remember that it's not as easy as that, and then that doesn't just correlate to the stock market going bye-bye, right? Because it's not so simple. Remember that there is also another component of the market which is relating to the bond market, which is called equity risk premium. And I wrote about it in the newsletter for this week, so make sure you read that as well. And we'll talk about equity risk premium during the webinar as well, and why it's important, and where we sit and where it's going to go to in the next couple of months. But the most important key takeaway that you need to understand about the bond market this week is that bonds and equities are finally uncorrelated, which we have been looking forward to for many, many months. I think many of you who have been listening to live stream for long enough, you would notice that we've been talking about this since the first start of the year, and we've been talking about this since like maybe even December, November last year. And we've been kind of waiting for this moment where bonds are moving in the opposite direction from equities. You can see that the bond market here, let's talk about just, for example, the fat tail of the bond market, which is TLT, is finally seeing inflows as the market sees a little bit of outflows, which is really good. This is a good thing. We want to see the bond market resume normal operations here so that we can have a more predictive credit cycle. And we'll talk more about that in later days. Okay. So that uncorrelation is a really nice setup. And that's all I have for you guys today. I think we talked a lot about the internal market structure today, which is, I hope, was helpful. If you did find it helpful, please leave a like behind, or you know what? Please just say something on the chat. Hey, none of you even said hello today. That's kind of sad. So you know what? I'm going to say hello, everyone. But I'm going to get on the Discord and trade live with the team right now. So if you're looking for somebody to tune in and trade a session with, remember to check us out, and head into the description where the link is. You can sign up for 14 days for free, and you can join us for 14 days for free on Discord right now and be live with us so that you can trade with us. Can you give us your opinion about NVDA? Hey, long time since I've been on with you. Johnny. Oh, nice to see you back, Johnny. Okay, let's talk about NVIDIA. Give me a second here. Okay, NVIDIA. I've pretty much taken this one off my watch list because it's been moving a little erratically. Okay, so on a weekly time frame, obviously this has been moving very, very erratically. Now, it did break out briefly here at 240, and then last week went zippity zip on Friday. I think that obviously here there is that potential upside window into two levels. The first level being 268, 269. Second window being around 289, 290, let's just say, right? But the thing about it for NVIDIA, and personally for me, is obviously this thing needs a pullback at some point, and more importantly, I don't see the benefit in playing this to the upside for the risk to reward ratio. One of the reasons why I haven't been trading this one is because the retail and the mutual fund / hedge fund interest in this has been extremely strong. So when everybody's crowding a specific trade, this makes me less likely to trade this because of the fact that everyone's crowding this trade, and then that makes the implied volatility of the options chain higher. It makes the likelihood of options contracts being just more expensive in general. Everybody chasing this upside, which I'm not a big fan of playing. I like taking and buying opportunities when nobody else is looking at it, and then coming into it as they grow into their valuation, which AI has been obviously driving the growth behind NVIDIA's stock price here, or rather the speculation of AI, right? More and more platforms are adapting, or rather kind of engaging with adding ChatGPT to their platform. And then also with that, you have Microsoft, you have Google, you have a bunch of others implementing AI, and obviously they need GPUs to do that. So that's why NVIDIA is being bought up here. It's growing into the valuation that it's coming to. For those of you that's wondering why NVIDIA is doing this. So, here's the thing. I think above 268, you could probably day trade this one into like maybe 275 or something like that. But right now, where it is, I think it might have a little bit of a wave down before it does that. So I would wait for a bounce, perhaps around 250 or maybe even lower, and that will probably give you a better setup into this upside further. Personally, I'm just going to stay out of this. I don't want to trade this because of the risk reward ratio. But if you're looking for that bounce level, I think it's going to be around 250 or 252. That seems like a decent level for it to come back to for a bounce. And then that upside trade into 270 makes sense. 270 breakout, pullback, then comes your 275, and then after that 289, 90 from there on, and to the upside. So remember that there is no guarantee that NVIDIA goes up to 269, no guarantee that it goes up to 290. So for all the retail traders out there that are looking at this and going yum yum, please be careful with getting too exuberant and keep your greed in check, okay? Remember that when you're thinking about all of this upside, question yourself and ask yourself, how can the trade go bad and how much money can I lose on this before you start fantasizing about that upside? Okay, so manage your risk, make sure that you have your risk management in play before you start taking that, okay? As always, this is great as I get back into being more disciplined about learning your trade. Hey Harshita, what's up? Welcome back. Nice to hear from you. And I'm glad that you're coming back into this and kind of coming back from your busy schedule. So thanks for tuning in. Good morning, boss. Thanks for the insight. No problem, Carlos. Nice to hear from you also. Long time no see. Johnny, 252 was my level to watch, then 270. Yep, pretty much you got it right. Yeah, I agree. I have 245 puts for April, about Friday. Okay, well, great. Make sure that you cash those out as soon as you see 20% profits, and then roll your contracts and just move your stop loss into profits and do the yada yada, right? I think you kind of know where I'm going with that. And then let's see here. Tesla short-term long and long-term short, possibly huge inverse cup and handle theory. Okay, let's have a look. I see what you're saying there with the inverse cup and handle. That's actually pretty decent. That's pretty nice. Yeah, I agree with you there. That could be a flush to 167. I don't disagree there. That's if this channel pretty much doesn't work out. So I do like that setup. Possibly, but once again, I will say be cautious with the cup and handles. They're not really like the best setup, to be honest. But you know what? I do see what you're saying, though. It is a legit setup. So okay, well, hold on. Let's see here. Short term, yeah. So short term, I think obviously the retest here for 185 is very possible, but I think it has to come down to 176 or around this level. So actually, Tesla's a good setup for short-term long, right, as you were saying. So I think if it gets down below here and starts to come down to the 175 level, around this level, I would be happy to perhaps take this trend line bounce risk reward ratio would be nice to the upside there, and then play it up into 180. That's what I would be looking for in Tesla. So I'm probably going to trade this this week, probably, if it comes back down here and test this level. Alright guys, that's all I have for you today. Sorry that I can't go on more. I'm going to jump on Discord right now with the team, our live trading session. So I will see you guys on Wednesday for the next pre-market live stream. I hope that this was insightful and helpful for you. Keep tuning in. We'll be having more announcements as we go through this market, and I'll be keeping you guys updated. And yeah, so I'll see you guys on Wednesday. Take care. Until then, peace.